Well, thanks to the trillion-dollar deficit, there appears to be little appetite right now in Congress for more stimulus spending. And that means that jump-starting the economy may rest squarely on the shoulders of Ben Bernanke's Fed. What tools does the Federal Reserve Chairman still have left? Rick Mishkin served with Bernanke as a Fed governor from 2006 through 2008. He joins me now this morning from Irvington, New York. Good morning to you, sir. It's great having you on the show. Tell me, give me the perspective of this week. We're looking at uncertainty about the economy more broadly, also uncertainty about just what the Fed can do. How did this week's decision to purchase treasuries change your outlook on what the Federal Reserve approach may be at this point?
Well, I think, first of all, we're clearly seeing a soft patch in the economy. It turns out that that's not uncommon in recoveries, to have periods where growth slows down for a period of time. In a sense, it's surprising that the Fed took an action now, particularly because the last FOMC meeting, all their discussion was about exit and not about potentially easing.
Right.
And yet we have actually a substantial reversal in policy in terms of actually raising the specter now that the Federal Reserve is thinking very seriously about doing quantitative easing in order to get the economy moving again. That's actually quite a surprise.
Yeah, you talk about that surprise. You make the important point that the last time we heard from the Fed chairman, there wasn't necessarily this indication that something might be coming this soon in terms of action. So that raises the question, is the Fed seeing something right now that the marketplace was not anticipating? Is there weakness out there?
I don't know that.
We don't know.
I don't know that, but one of the problems here is that by taking this action, it actually is raising the issue that the Fed is more nervous. Basically, we've had weak data just in the past month or so, and yet this is actually a significant policy step. So one of the problems here is if the Fed did not intend to indicate that they really think that a lot more needs to be done right now, they've actually created worries in the market that in fact things are going to be worse than people previously thought. Mm-hmm. So that's one of the tricky issues about moving to this policy for them.
So what do you think this $2 trillion floor for the securities portfolio, really does for the Fed? I mean, we're looking at borrowing rates being pretty low right now. Does this change the velocity of money? I mean, what's the bottom line for the economy?
Well, I think that when you think about doing the kind of measures of expanding the balance sheet, there are times when I think that they can be very effective. And particularly if there's financial market disruption, then I think that taking these kind of actions, which are very unusual for central banks, are when they are actually effective. And when you look at the research that these actions of basically expanding the balance sheet and buying the mortgage-backed securities look like they had significant effects in terms of long-term interest rates. Mm-hmm. And I think were helpful in terms of getting the economy moving, and particularly helpful in convincing people that the Fed wasn't going to stand by and allow a depression to occur. It's much more questionable that whether you can have these policies be as effective when financial markets are more stabilized. So we already see interest rates very low. Mortgage rates are about as low as they're as low as I've ever seen them. Mm-hmm. And I'm not that old, but I'm old enough that this is really still quite a surprise that they're so low. And so it's not clear how effective particularly a measure of the type that the Fed just did will be in actually stimulating the economy. And by the way, there are some serious costs to doing so. That quantitative easing is not a costless type procedure because it does raise issues about having the Fed have their balance sheet now situated so that they will have a lot of long-term securities on their balance sheet, which subjects them to potential losses if interest rates go up. And actually, from a point of view of the pure economics, that doesn't seem to be that big a deal, because you could think of the central bank as just part of the government, and so it's not a big deal. But from a political viewpoint, it is a big deal, because if there are losses on the Fed's balance sheets, believe me, the politicians will come after the Fed, and that could be really serious in terms of the Fed's independence.